Ladies and gentlemen, good day and welcome to Jyoti CNC Automation Q3 and 9 months FY2026 earnings conference call, hosted by Equirus Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company and may involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Harshit Patel from Equirus Securities. Thank you, and over to you, sir.
Thank you. Good evening, everyone. On behalf of Equirus Securities, I welcome you all to third quarter and 9 months FY26 earnings conference call of Jyoti CNC Automation Limited. We are pleased to have with us management represented by Mr. Parakram Singh Jadeja, Chairman and Managing Director of the company. We will have opening remarks from the Jadeja sir, followed by question and answer session. Thank you, and over to you, sir.
Thank you, Harshit. Good evening, everyone, and a very warm welcome to our Q3 and 9-month FY26 earning conference call. Along with me, I have a senior management team and SGA, our investor relations advisor. Results and presentation have been uploaded on the stock exchange. I hope everyone has had a chance to go through the same. I'll begin my opening remarks with overview on the economy front, followed by highlighted on the company. India's economy continues to show a strong growth momentum, supported by healthy domestic demand and steady policy reforms that improves competitiveness and boost investors' confidence. The Union Budget 2026-27 has reinforced this direction by focusing on long-term investment and structural growth. A key highlighted of the budget is the continued emphasis on public capital expenditure as a main driver of growth. With an allocation of 12.2 lakh crore for FY27, around 9% higher than the previous year. This sustained a capex push is expected to strengthen infrastructure, encourage private investment, and provide long-term visibility for the manufacturing sector. The budget has also announced a focused measures across sectors Jyoti CNC is catering to. The launch of India Semiconductor Mission 2.0 aims to expand a domestic semiconductor and equipment manufacturing, along with chip design capabilities, which will drive demand for high-precision machining. Electronics manufacturing has been further supported through a 40,000 crore outlay under the Electronics Component Manufacturing Scheme, helping scale up EMS and component production. In defense, higher capital allocation to domestic aerospace and defense manufacturing strengthen the push for self-reliance, where precision engineering play a critical role. Similarly, a continued policy support for the automotive and auto component sector through PLI schemes and duty reforms have reinforced India's position as a preferred manufacturing hub. On the global front as well, a greater clarity around tariffs supported by a free trade agreement signed with EU and US is expected to provide a meaningful boost to our exports-oriented end-user industries. This improvement in trade visibility should support demand across global markets and create additional opportunities for companies like ours. Overall, the current environment places both country and Jyoti CNC in a strong position, driven by a clear and sustained focus on manufacturing. In this context, the role of mother machine manufacturers, companies that build a precision machine used to produce other machine tools, become especially very critical. As manufacturing activity expands across sectors, the demand for reliable, higher quality CNC machines is expected to rise meaningfully, creating a long-term opportunities for players like Jyoti CNC. Now, speaking of Jyoti CNC, as highlighted earlier, the Indian CNC machine tools market continued to be largely served through import, presenting a significant opportunity for domestic players. To strengthen our presence and capabilities and capitalize on the opportunity, we are undertaking a large capacity expansion in India, increasing our manufacturing capacity from current 6,000 machines to 16,000 machines by September this year. I am happy to announce that the capex is progressing as planned, and we will be able to ramp up sooner than expected on the back of huge industry demand and our product in India and globally. Alongside a capacity expansion, we have also made investment in a talent development, including upskilling our workforce and setting up an in-house training institute to build up a pipeline of over 1,000 skilled engineers. These initiatives form a critical part of our long-term growth strategy to deliver high-precision machines across diversified sectors and support a sustained growth. At the same time, R&D and innovation remain a key strategic priority. We continue to advance our product development efforts through initiatives such as the HUMA control panel, along with plans to integrate proprietary controllers, drives, and motors. These steps will strengthen our product offering, technology capabilities, and reduce import dependencies over a period. In parallel, we are actively exploring next generation products for high precision applications, including semiconductor equipment, which we believe can become a meaningful growth driver for the company in the coming years. In summary, we are expanding capacity, strengthening our talent base, depending our capabilities, and preparing to serve a much larger and more global customer base. We remain financially disciplined and future focused, and we are confident of delivering a sustainable growth in the years to come. Now I will share with you the key updates of the company. In November 2025, we expanded our capacities at Huron, our facilities in France, almost double in line with our growth plans. This expansion strengthened our manufacturing capabilities and positions us well to meet a rising global demand. Huron continued to serve as a key technology hub for the company. With a strong focus on high-end machines catering to global customers, with the increased capacity, we are better equipped to address a growing demand from the aerospace sector and expand our global footprint. We have commenced assembly operation at the facility and are seeing healthy ramp-up with material traction expected to reflect from FY27 onward. We are seeing a strong traction from defense sector, both in India and across global markets. We have a healthy order book of aerospace and defense of close to 41% and around 1,900 crores, reflecting growing confidence in our capabilities and the increasing demand for high-precision machining a solution in this segment. With the ramp-up of our capacity at Huron, a capacity expansion at India coming live in September 2026, and a strong growing order book across sectors, we expect the coming period of the significantly stronger, supported by improved execution, higher deliveries, and sustained demand across our key end markets. Before I begin my update on the operational and financial performance, I would like to briefly explain the nature of our business and the reason behind our higher inventory days so that everyone has the right context. Ours is a manufacturing business with a long production cycle, and the working capital requirement is largely driven by inventory. We operate across three broad product categories. In entry-level machines, which are largely supplied to EMS, automobile and auto component and general engineering. The manufacturing cycle is around 3 to 6 months for mid-range machines to a low-level machine. The cycle extends to about 9 months. For large and complex machines, the manufacturing cycle can range between 12 to 18 months. Given this long build cycle, inventory naturally remain on the balance sheet for extended period. Historically, our inventory days were much higher than the current level. Over the last few quarters, through a better planning, execution, and process improvement, we have been optimizing our working capital cycle and seeing positive trends in which will release and shorten the intensity of working capital requirement. And we are on a trajectory of that. Speaking of the financial and operation performance for the quarter and 9 months ended FY26, we reported a strong consolidated revenue growth of 28.1% for the quarter, standing at rupees 576 crores. In line with our internal expectation, our performance for the 9 months was also strong, with consolidated revenue of rupees 1,494 crores in 9 months FY26 compared to rupees 1,242 crores in 9 months FY25, reflecting a growth of 20.3%. With strong order book, stable economic and geopolitical situation, capacities in place, and execution rigors, we are optimistic of a stronger Q4 and FY27. Historically, also we have witnessed that Q4 is among the best performing quarter across the financial year, and we anticipate the trend to continue this year as well. Speaking of segment revenue for 9 months FY26, 42% came from aerospace and defense, 28% from auto and auto component, 22% from general engineering, and remaining 8% from other sectors including EMS and dies and molds. Our order intake for 9 months FY26 stood at rupees 1,661 crores. This includes a 46% from aerospace and defense, 30% from auto and auto component, and 17% from general engineering. Speaking of our current order book, it remains healthy and well diversified at rupees 4,585 crores, reflecting a steady demand and continued customer confidence. The industry-wise, a breakup is as follows: 41% from aerospace and defense, 19% from general engineering, 18% from auto and auto component, 14% from EMS, and the balance from other sectors. Let's coming to the margins. EBITDA for quarter 3 FY26 stood at rupees 155 crores, a growth of 37.3% compared to the same period last year. EBITDA margin were 26.8% compared to 25% in Q3 FY25, a growth of 180 basis points year on year. EBITDA for 9-month FY26 stood at 379.4 crores, a growth of 21.1% year on year. Profit after tax for Q3 FY26 stood at rupees 89 crores compared to rupees 80 crores in Q3 FY25, reflecting a growth of 10.3% for 9-month FY26. It grew by 18.5%. Lower growth in PAT is largely attributed to increased finance cost on account of a capacity expansion plans, as this capacity is coming in live and will start contributing to revenue and profitability. We will see interest burden being absorbed and reduction in debt, which will enhance the overall profitability significantly. As we entered FY27, Jyoti CNC is well positioned with stronger order book visibility and key capacity expansion, a project nearing commissioning. With sustained demand across sectors and improving execution, we remain confident in our growth outlook. We look ahead with optimism, supported by our manufacturing scale, technology focus, and long-term commitment to value creation. We may now open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aniket Jain from Yes Securities. Please go ahead.
Good evening, sir. Congratulations on posting really good set of numbers. So my first question is on the India, EU as well as US trade deal. So I think India is reducing the tariffs, at least for European Union, from probably 18 to 20% to near zero now, while EU's tariffs are already in probably low single digit. So are we anticipating any kind of competition from European Union suppliers? What are your views on EU as well as US trade deal?
So thank you, Aniket. Basically, I'll let you know that in a machine duty today, the machines are coming from EU. Its duty was only 7.5%, and all these machines, customers were importing against the exports license there. So almost every customers today, what the machines are coming from Europe and USA, it is in machine tool industries are almost at zero duty there. So there is no significant change in terms of a competition over there. Rather, we are feeling a little bit better there now, because all our import content, like we were importing the controller from Siemens, Germany and all, our duty was 7.5%. This will going to be zero for us. So basically that will be a cost advantage is going to come to us. So we are looking very happily to see this deal there basically.
Understood, sir. And sir, for US, are I think we had plans to set up a sales office there. So have we, is there any progress on that? And yeah.
Yeah, thank you, Aniket. Basically, we were just looking at the appropriate time. So we have last 2-3 months, we already progressed all the company registration, legalities and all is over now. And within a 1 quarter now, we are, let's say, appointing all our sales team and our tech centers and all. Hopefully, this operation will be starts and within the next 2 to 3 months. Very aggressively, we are going ahead in US there.
Understood, sir. Sorry, if I can squeeze in one more. So we are nearing production. So basically, we are nearing the capacity expansion for our Rajkot facility, but we are yet to receive any material orders for EMS. So I just wanted to check if you are anticipating any kind of orders during this quarter or maybe in Q1 of next year. So that our capacity, as and when it comes online, we have ready orders in hand so that it is optimum utilization. So what are your thoughts on orders as well as?
Aniket, everyone is looking to answer of this. Basically, we are fully prepared. Even our capacity is also coming up, and we are fully booked with the order book of back to them. And right now, we are working with the many more suppliers, many more manufacturers, and approving their process and all. Basically, all this, the future customers, they are also expanding their capacity. They are all on execution level there. Once their plants and things are ready, I think they need the further machines and all. And we are very much hopeful to get the few orders in the coming quarters there.
So basically in Q4. This quarter or maybe in Q1?
Maybe on a Q1 there. Maybe on a
maybe
Q1 there.
Thank you so much for answering the question, sir. All the best. I'll get back into the queue.
Thank you.
Thank you, sir. The next question is from the line of Yash Patel from Kotak AMC. Please go ahead.
Hello, sir.
Hi, yes.
Sir, I wanted to ask you about the cash flow situation this quarter. Can you throw some light on what were the cash flow this quarter?
Yes, bye. We are on a, let's say, end of the year, what we are discussing in past also. So we are on a very positive trajectory on a cash flow side there. So we are moving ahead, very positive cash flow in a direction in a Q4 there. You saw that in Q2 on a half yearly, we were at break-even level, let's say, as a positive there. Similarly, we are at a similar level, and we are hopefully that it will be a last quarter is always to be a better quarter for us. So we are looking very positive cash flow.
Okay, sir. Thank you.
Thank you.
Thank you, sir. The next question is from the line of Manish Otswal from Nirmal Bang Securities Private Limited. Please go ahead.
Yes, sir. Thank you for the opportunity. I've listened your initial commentary on the industry, and we all understand the industry is a very strong outlook in terms of growth. But when I look at, sir, our order book position, especially this year compared to the last year performance, last year, FY2025, we started an order book of 38 crores and end up 43, 46 crores, 26.4% growth. Whereas in this YTD basis, in this particular financial year, order book growth only 5.5%. So order book growth has disappointed materially. So can you make detailed comment why the order book growth is not happening? And what is our current capacity utilization in the business?
So Manish ji, thank you very much. See, basically now today we have reached to order book is almost 1.5 years to 2 years. These industries are not ready to listen to us for the longer delivery period. So there is not any, you are able to see that numbers are growing higher there. Okay. The way let's say this year our capacity utilization has touched to almost 90% now. Once our new capacity will come in a picture and we deliver the old order book there, we will see the traction to be more over there today. Okay. And we will build a new order book on a bulky order book on that, then after only that. Once the capacity expansions are going on. So today, let's say once it is on there. Today we are at almost 4,600 crores. It's a very heavy order book, and no more customers are ready to wait more than 18 months delivery commitment there.
So basically, sir, because of supply constraint at our end, we are not taking the new order, or customers not placing new orders to us till our new capacity come on stream. That is the way I should understand.
Absolutely. Because if I get any new orders from a very bulk orders and all, my delivery period is going to be more than 18 months there. Okay.
Yes.
No customers are willing to wait for 2 to 3 years there. So 4,000, let's say, if you look at that, 18 months order book is a very hefty order book for our industries there.
Mm-hmm. Understood, sir. The second question on our capex plan on the new capacity, I believe we have taken term loan of 300 crores from Union Bank. So how much we have used it for this capacity expansion program, and how much we need to spend more through term loan?
So basically this year, you know that we have earlier announced that we are going to do 400 to 450 crore capex. And we are behind that very aggressively to finish as early as possible, because today's our growth are been a constraint based on the capacity today now. Okay, so we have used that almost 200 plus crores from Union Bank, and we will use this financial year aggressively as soon as possible to finish the capex over there.
Right, and the last question on the supply chain situation, because lot of components we import from Japan. So how the supply chain situation is stable, it's volatile, or currency impact? Can you talk about that thing? That will be my last question, sir. Thank you.
Today, our supply chain is very stable in terms of internationally. Japan and Germany are well supply chain. There is not much issues over there. It's a very stable supply chain. We are seeing that. Okay.
All right, sir. Thank you very much. Answered all my questions.
Thank you.
All the very best for the coming quarter.
Thank you. Thank you very much.
Thank you, sir. The next question is from the line of Bala Subramanian from Arihant Capital. Please go ahead.
Good evening, sir. Thank you so much for the opportunities. Sir, we are planning to develop proprietary controllers, drives, and motors under ELK. We're going to 4 to 5% of gross margins. Just want to understand this proprietary controllers, it's meaning we are going to place CNC controllers like Fanuc and Siemens, which is widely used in the industry. So I think we are taking with Huma as a front-end HMI. Moving to full-stack controllers involve decades of cumulative software stabilities and servo tuning expertise. I just want to understand beyond prototype, what specific milestones we are planning to achieve under the PLI schemes. Whether we are developing entirely to Fanuc or Siemens, and how it will reliable compared to those softwares, and can able to make it reducing royalty or import cost at the component level. So if you share more details about the controller part.
Thank you, Bala. See, particularly on a journey of a Atmanirbhar Bharat, there is a background noise coming. Please ask someone to mute.
Bala, sir, can you
Yes, sir.
mute
Yes,
yourself?
sir. Yeah.
Thank you, sir.
Yeah. So basically, for this journey of a CNC controller development and Atmanirbhar Bharat over here, see, in a decade, this Japanese and German manufacturer has developed this product, and they have made mastery, and let's say today they are driver of the motion control over here. Our journey is starting now, but we have now experience of our now Jyoti has completed almost 30 years plus, and Huron we have 190 years plus experience people are available there. So we have a very in terms of a drive tunings and fine tuning the parameters and all on a control design side, we have a very experienced, knowledgeable people available. Plus in our country today, very youngsters, the new people, and all our institutes like IITs and the CMTS and all, this all people together, we are quite confident that, and we are able to manufacture, design, develop, manufacture reliable product, not only the reliable product in terms of a technological forefront over there. Okay. So let's say today, any new technology coming, they will always to be one step ahead in terms of a more advancement, because those guys are not able to change the platform very easily once the product has been developed. So we are very much confident in terms of that, and looking forward to develop one of the best controller in this earth there.
Okay, sir. So
I think I given you the one part of that. What was your next question there inside that?
Sir, how, if you could explain PLI scheme for proprietary controller drives and motors.
Yeah. So basically, the electronics component manufacturing scheme, what you have already, the government has expanded the budget also from 20,000 crore to 40,000 crore. So we are eligible over here to be on a capital subsidy over there. And there is a specific mark out there for capital subsidy. The amount what is been disbursed by, let's say, been granted by the central government, same amount will be in Gujarat government also. So we are expecting to be a very large number of this scheme advantage going to be received to manufacturing these controllers, drives and motors and sensors there.
Okay, sir. And sir, another part, 4 to 5% gross expansion, it's entirely dependent on replacing Fanuc or Siemens controllers entirely, or it's reducing a royalty or input cost at the component level. Just a follow.
So basically, these are the very high value import items, and particularly on a high-end machines, the cost of these controllers are very high there. Okay. So definitely we are able to, and once we are manufacturing in India, and now all electronics components manufacturing ecosystem also has been developing so nicely in India. So even the microchips and all are also is going to be available made in India chips only. So we are no more dependent on future on that. So our cost controls will be very much in our hands there.
Okay, sir. Sir, my last question, we are designing products for semiconductor manufacturing machine builders. I think it required extreme precision, even nanometer range. I just want to understand what kind of market we are targeting. It's majorly for front-end fabrications or back-end OSAT assembly side. Get more color.
So basically, yeah, thank you, Bala. Basically, in a semiconductor side, you are right there. It's required a nano precision, and based on this experience at Huron as well as Jyoti, we are now entering into a nano precision over there. We are going to create the infrastructure to produce the nano precision over there, and particularly we are targeting to equipment to build a semiconductor chips there. So we are designing and developing many differential process on from casting foundry to inspection units, and many more equipments are there. Around 8 to 10 different technologies we are developing over here in equipment side to serve to our semiconductor mission 2.0 there.
Got it, sir. Thank you.
Thank you, sir. The next question is from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity. So, just one question on the part of, say, if we deduct standalone from console. So if I see the revenue, so it is down 7% year-over-year. So it may be because of ramp up in the Huron. So can you highlight, say, because on a console basis, our margins are looking lower or the growth in EBITDA looking much lower, while on the standalone it is looking very strong. So because on standalone we have done 165 crore of EBITDA, while on consolidated basis it is 155 crore. It may be because of like a ramp up in the expenses at the Huron operations, while the revenue has not reflected yet. So can you share some highlight or insight into the Huron
Absolutely.
operations and the gap between the earnings?
Already, what you are saying is absolutely right. You answered yourself only, Kamlesh bhai. Definitely, the revenue has not been came over here, and the cost has been incurred. In this now with our new facility comes on a pictures. We have add on around 27 more people in a manufacturing in a France to ramp up our production furthermore now there. Even in terms of inventory building up also, we have started very aggressively and supply material from Jyoti to there, and we started all floors and everything like that. So you will see this be very normalized things and number wise in next year. Quarter on quarter, you will see more and more Huron numbers will come very positively on a growth side there. Once the growth we will able to execute there, all these costs will be absorbed and you will see the EBITDA level will increase 1+1 like that.
Okay, great, sir. And sir, if I see margins, like if I just do the math, EBITDA per machine, like say it is roughly around 10 lakh rupees in this 9 months. So going forward, as our execution improves and the new capacity comes in, Huron further complements the expansion in the growth. So where do we see our margins? Like, so do we see significant jump in the margins because the scale and like large capacity expansion comes into play? So that would get absorbed over larger base in terms of fixed costs. So where do we see our margins? Because in state there is some concern that the margins are not there, because year over year our margins are at 10 lakh rupees, which was 11.5 lakh rupees a year back on a 9-month basis.
Thank you. Kamlesh bhai, I am answering to you on a consecutive last 6 calls on the same question. And my answer is same. Let's say we are delivering, we are committed, and we are seeing that there is no margin pressure we are seeing at a 25% or so EBITDA. And if someone, let's say, if it is increasing, it is okay, but we are not seeing any pressure on that to below that. So we are fully committed in the next coming 2 years. The way we have an order book with us, we are very much sure that our margin parameters will be maintained very strongly for the next coming 2 years. That's the visibilities we have it today there.
Great, sir. And sir, you have highlighted in your presentation with regard to the semiconductors. So are we catering to the semiconductor sector as of now, or we are developing the machines to cater to that?
So we are developing the technology today, okay? And once the technology, we will reach out to that same level of requirement, then we will launch our product there.
And how much time lag could be there, like say from current date, or what time period we would be able to have the product?
So I think we are seeing that in the next 2 years, definitely we will come with the commercial product to be launched there.
And lastly, sir, can you give the breakup of machines, like say entry level, mid level, high end, and the commensurate revenue in those machines?
Yeah. So let's say Q3, the entry level the machines is 1,207 at a value of 247 crores. The average is 20.46 lakhs. Mid level, we have 128 machines and value is 83 crores. Average is coming 64.84. Around 23 machines at value of a 221 crores. The average is coming at 9.6 crore. So the total number of machines is a 1,358, and the average is coming as a 40.5.
Great, sir.
Is this okay, Kamlesh bhai? Yeah.
Thanks a lot, sir. Thank you.
Thank you.
Thank you, sir. The next question is from the line of Shrinik Mehta from Indo-Alps Wealth India Limited. Please go ahead.
Hello, sir. I had
Hi.
a couple of questions. One, I wanted to ask you, you had almost 4,600 crores of order book. What is the advance that we take when we do this order book?
So let me tell you, while we take any entry-level product, okay, and in entry level we have a common, let's say around 5% is a minimum advance to be with us there, okay. And while the high-end machines, okay, while high-end machines for exports and all, so there we are able to get a milestone payment also, and we are getting at around 10 to 15% advance. But in a government orders, let's say we have a many government defense orders, there we are not getting the advance there. Government don't give the advance there. Yeah.
Okay. Because this will be always your key concern when it comes to the operating cash flow. As you're seeing the trend, you are making a lot of net profit or the operating profit, but your operating net cash from the operating activities has been negative. And there is a big difference. On one side, you earn almost 500 crores, other side, you have a negative 100 crore net cash from operating activities. And going forward with the expansion of the capacity, your requirements of the inventory will remain quite high, even in the next few quarters. So I don't know if you have some idea about when you expect this cash flow from operating activities to be in line with the operating profit that you make.
Yeah. So already in my first question, I answered to Aniket there, and my answer is same, that you will see the things. We are on a growth trajectory. One side we are capacity expanding, second side we are expanding, but our overall inventory days we are reducing from very large to that. Once the scale up has reached on an economical scale, has reached that our inventory days also will reduce that. So you will see quarter on quarter very significant improvement from the next year. Even you will look at that end of the year, you will see a positive operating cash flows to be there.
Okay.
We are very much worked on that, and we are on line with them.
Okay. And for your French Huron capacity expansion, which has happened sometime in November, when can we expect the sales to start showing in our quarter after quarter results?
So the growth we are going to see from first quarter onwards, because there is a manufacturing time time for the machine is longer there. So we will see the good numbers the first time. We will see the numbers. You will see the growth trajectory from quarter one onwards there.
Okay. Thank you so much.
Thank you.
Thank you, sir. The next question is from the line of Jenish Karia from Union AMC. Please go ahead.
Yes, thank you for the opportunity. Good evening, Jadeja bhai. Considering that the private capex will pick up going forward, should we see a growth accelerating, and can we guide for a 25-30% growth in FY27 and northward of 30% in FY28?
Yes, absolutely. FY27 you can consider same numbers of 27 as well as 28.
Understood. And you mentioned in your opening remarks that aerospace, defense, and auto ancillaries are some of the sectors you are seeing incremental growth coming from an order book building up. But apart from that, are there any specific sectors you would highlight both on India and global perspective where the growth you see accelerating, not in the current order book, but in the upcoming order book?
So basically, the entire manufacturing is growing. I always very much difficult while I am presenting numbers to you to combine the general engineering and auto and all like that. Okay, so many manufacturing sectors are growing: valves, pumps, domestic, and every area. Today, I have a 14,000 plus customer base in India. We are consolidating and bringing this number into 4 sectors front of you there basically. Is exploding on a completely on a manufacturing. If you look at that, the Viksit Bharat, India's target is to be a $30 trillion economy and 25% of a manufacturing. 25% of manufacturing, today we are at 13%. And growing this economy at 6 to 8% in between. You can understand every sectors are going to grow there. Every sectors. Railway, apart from what we are not discussing over here, we are seeing the very tractions on a railway. The railway component manufacturing is increasing and we are supplying many machines to them. But it falls under category of we call as a general engineering. If you see that every quarter on quarter our general engineering baskets are increasing there.
Understood, sir. And just one last thing. What would be the revenue mix from exports currently, and do we see that changing materially, improving on the export side going forward, or will be majorly focusing on the domestic growth story?
So, Janice bhai, we are very much focused to be maintain around 35 to 40% is to be exports and 60-65% to be domestic. And this is in line. We are looking for the next couple of years. It is going to be maintained similarly like this.
Perfect, sir. Thank you. Thank you for the opportunity and all the best for the future.
Thank you. Thank you.
Thank you, sir. The next question is from the line of Aniket Jain from Yes Securities. Please go ahead.
Yes, sir. Thank you for taking my question again. So I had 2 more questions. So number 1 is on the material cost inflation. So I believe there is probably 20-30% of your total cost could be coming from the raw materials, maybe steel, aluminum, copper. So are we hedging those, or how are we protecting our margins? Is there any price escalation clause included in the contracts?
Aniket ji, we are in absolutely on a natural hedging scenario. See, the every orders are fixed orders. We are not having a long-term contract to repeat to same price to give a next machines to them customers there. And you know that our inventory cycles are almost 200 to 240 days of our manufacturing. Whenever this this commodity prices plus and minuses, okay, we are transferring on a same next month to the new customers, and we are able to balance these things there.
Got it, sir. And probably one more on Huron. So I did some reverse calculation. I think one more participant asked a question. So on Huron, what are the revenues? Because on my numbers, I think it is coming between 45 to 50 crores versus probably around 60 crores in the last quarter. So why is there a decline on Huron?
No, it's not decline. I'll tell you one thing. It's because of a console level. We have I told you that we are now increasing the new inventories and everything there. So there is in the console level, there are more material been dispatched from Jyoti to there. So in a console, it has been reduced there basically. Okay. Otherwise, so, right now there is is almost, it is little bit higher than the Q2 numbers to Q3 numbers there.
By any chance, are you able to share the number? Not sure if you're comfortable doing that, but what is the Huron's revenue and how much are we sending from Jyoti to Huron?
Yeah, absolutely. I'll just find out, and I'm not front of me there. I'm right now in Huron right now.
Awesome. Yeah.
Okay. I'll share with you the detail there. Yeah.
Sure, sir. And probably last one, so our gross margins increased to 57% now. So what kind of margins are we making on the high-end machines? And probably is there any increase in the margins for low and mid-end machines as well? And are we able to sustain these kind of margins, or is there a one-off or probably a temporary situation? Although it has been
See, basically, Aniket bhai, we are always working is more and more is to be our value addition program. Okay, based on this, our a complete back-end manufacturing cycle and whatever the critical sub-assemblies and all we were importing, we are adding more and more. Even our local entry-level product also, we are expanding the margin. Of course, our margins are much better on a high-end machines, and we are executing like that. In between, I'll tell you the this our quarter 3 in a Huron. My sales is 80 crores, not 45 crores.
The Huron is 80 crores. Okay.
Yeah, and then total together in 3 months is close to 222 crores in 9 months there.
Okay.
Yeah.
So how much is then out of 80 crores? So probably 35 crores is being exported from Jyoti to Huron. Am I correct in my understanding?
Yeah. So basically at console level, let's say whatever the manufacturing is going to increase there, the 70% goods are going from here to there. Okay. So if you look at that, this year we have close to 85 crores worth of material has already been supplied to them. Okay. And that's how we are going to see the future expansion growth are there. Okay, that's right now it is affecting to us in a console level. It has been removed. Okay.
Yep.
And once it will be executed from Huron, that number will come in a picture there.
Got it, sir. Very clear. Thank you so much for taking my question.
Thank you, sir. The next question is from the line of Keshav Baradia from Wallfort Financial. Please go ahead.
Hi, sir. Congratulations on a great set of numbers. So just one question I had. You mentioned that we were trying to get our working capital cycle more in control by various efforts that we're taking. So could you talk a little bit about how we're trying to get those inventory days down and optimize working capital? That is first. And so second, we've seen a lot of tensions between EU and US, and that has led to a renewed uptick in defense spending globally. So is there anything that we are looking at inorganically to kind of increase our wallet share with European customers or get access to newer customers to kind of capitalize on that opportunity?
Thank you, Keshav. Basically, about the inventory optimizations. See, the Jyoti is having more than 200 plus product variants. In the last 3 years, we have reached out to almost 2.5 to 3x on a similar SKUs. So based on these SKUs, our optimizations are coming. More and more scale will increase. Further more optimization will come on the same set of SKUs. We are delivering the more. So my inventory is becoming optimizing there. That's one. Second, now in a new plant, we are doing a lot of automations over there. Okay. Those are our general, some of the manufacturing processes was in manual. That's we are putting into very sophisticated automations are going to be in a place to be there. So we are seeing further optimizations are going to be seen over there in terms of a flexibility on the manufacturing, easy setup change and everything like that. That's the one part. And that's how we are looking to be in growing forward. Going forward, we are looking to be more and more optimizations on there. Your second question about the EU and this area. Yes, there is a lot of now after the EU deal, we are seeing a lot of already there are delegation has came. I met many people over there and all. And we are seeing that the more and more investments are going to be happen in Europe there. And particularly Germany has taken a lead in terms of a defense manufacturing. they are going to spend more than $500 billion. And rest all the other people together, they will invest close to $1 trillion in coming days. And already our all salespeople are working with them very closely. We are seeing that aerospace, defense, as well as very high precision manufacturing in EU zone is increasing dramatically there.
Oh, got it, sir. Wish you all the best.
Apart from that, I remember just now. Apart from that, I like to tell you one thing more, that we have recently now we started our China operations also there. We are going to furthermore on China with our sales activity there. And all these geopolitical situations, every country has started investing there. So we got in this quarter, we got a good numbers orders from China as well there.
Got it, sir. That's very helpful. So, sir, as part of our efforts to get more automation in the general manufacturing processes of the new plant, do we expect that to kind of help margins more from the 26-27% level we are right now once that, sir?
I think here I'm always giving a one simple answer. Okay, so yeah, there is possibilities are there. We will improve some margin, but I would like to be very, let's say, conservative over here, and I'll not like to guide you that from 25 to 30. Okay, we'll be in a range in between 25 to 27%. Already we are on one of the best in the industries we are serving over here. There.
Great, sir. Thank you so much, and wish you all the best for the future.
Thank you.
Thank you, sir. The next question is from the line of Manish Oswal from Nirmal Bang Securities Private Limited. Please go ahead.
Sir, I have only one question, like of the total inventory which we have, what is the breakdown of RM versus WIP as on 31st December 2025?
1 second. So I think I have given a number on a half yearly. I need to take from this number because I'm sitting on a France right now. Okay. I can send you the details. Yeah.
All right, I connect to your office. Thank you.
Yeah, definitely we'll send you there.
Thank you, sir. Ladies and gentlemen, due to time constraints, we'll take this as the last question for today. I would now like to hand the conference over to management for closing comments.
Thank you all for joining us today. I hope we have addressed all your questions. We remain committed to keeping the investment community informed with regular updates on and development in the company. For any further information or queries, please feel free to reach out to us or SGA, our investor relation advisor. Thank you very much to all of you there.
Thank you, sir. On behalf of Equirus Securities Private Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your